Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Nomad Foods Ltd. Now, what is Nomad Foods? Nomad Foods, as the pictures from their investor presentation show, is essentially a brand that sells frozen foods. They sell them mainly in Europe. Most of their income, over 80%, I think, comes from Europe, right? Mainly the United Kingdom, France, Italy, Spain, etc., Croatia as well. So here's some pictures from their investor presentation, just from the different sorts of products that you can see. They have many different little brands depending on the countries that they're selling. So you may be, if you're European and you regularly buy frozen foods, well, you may have been buying stuff from Nomad Foods without even knowing it. Now, I want to jump straight into the financials because I think it's an interesting company, and let's talk about it. So, their revenue has been growing since 2020. This is wonderful, right? So, they were earning 2.5 billion billion euros, and nowadays it's close to 3 billion euros, right? I wouldn't be surprised if by the end of 2023 they're earning 3 billion euros. Now, their gross profit has also been growing overall, although the margins seem to have been compressing a little bit. Same with their operating profit, same story with the net profit, right? So 2021 was a bit of a down year. That's okay. But the longer term trend, if you look, for example, at a 10-year chart, revenue has been growing very consistently. They're a very consistent company. They've just seemed to be expanding, acquiring a few other companies that help them expand even further. So they're a very consistent revenue grower. The picture for the other margins and kinds of income is a little different. So we see here, for example, that the gross margin has suffered a little bit. This coincides with the rise of inflation, of course, in the Eurozone especially. It's been a little tough in the Eurozone, and it seems to have been a little tough for them to pass that on to consumers, because now you see here that the gross margins are decreasing, right? Even at an adjusted basis, which just adjusted a little bit in 2021. Now, it's not mission critical, it's still growing. The gross profit is still growing along with the revenue. So it's not like this margin decrease is something that is just sounding the alarms everywhere. We should be very concerned about this, but it's just something to note. So, and this is the same thing with net income and with operating income, where the operating margins and the net income margins have suffered a little bit in the last 2 years, especially relative to 2020, but these are not critical numbers yet. Now, if we look at the third quarter 2023, the most recent quarter, we do see revenue growth is in order, gross profit lowered a little bit, same with the margin, which went down by 70 basis points, which isn't a ton, to be fair. Like, to be honest, it's not critical, as I said, but the EBITDA did go down as well, and so did the earnings per share. That's just something to note. They are clearly affected by the economic situation in the EU, where stuff is slowing down, especially in countries like Germany, where economic growth has just been a little stagnant, right? And we also see, though, free cash flow growing, which is great. At the end of the day, what I, as an investor, care about the most when I'm looking at the health of a business and when I want to invest in a business is that they generate cash money. And if they can turn more of that growing revenue into growing free cash flow within this 9-month period, I am still pretty freaking happy. So their free cash flow seems to be pretty healthy, but we have to also put this in a model, right? I'm going to put this all in a model, but first I'm going to just talk about cash flow from financing activities because they have a lot of debt. And this is something that we'll see in a second. So we'll see here that if we go to the cash flows from financing activities, we'll see that they have mostly repurchased a whole lot of shares, right? They've also repaid a lot of loan, but they've issued a lot of debt. So a lot of their cash is going back and forth between issuing debt, repaying debt. Overall, they seem to have repaid a little more debt than issued more debt. Actually, that's not true. They seem to have issued a little more debt. So it's important to just see this overall picture. But the share repurchases have driven value, especially in 2020, 2021, 22. That slowed down a little bit, but they're not really issuing new shares, which is good to know. Likewise, here's the amount of interest they're paying. They're paying 50 million euros every single year just to have the interest of the debt paid. So let's make a model. Let's make a discounted cash flow model. I do this with most of the stocks that I value, and this is basically grabbing a 3% growth rate, 4% for 2023, and 3% in perpetuity, basically, and just saying that 10% of their revenues are going to turn to free cash flow. Okay? So I have a required rate of return of 11%. That's 1% more per year than the market, and that compounds to be quite a lot over the course of decades. So that's my rate of return. My perpetual growth rate is going to be 3%. I think that's pretty reasonable for a food company. I don't think it's going to see 0% or even decline. I don't think it's going to be stellar. It's really hard for a food company, especially in supermarkets where there's just a ton of brands, to grow at those astronomical rates. And if it does, it may be because of an acquisition, so that may happen for 1 or 2 years, but in perpetuity, it's a little more difficult. So I'm just going to put 3%. Now, I'm going to divide that by the total number of shares out and add all those free cash flow years, and I get a fair value of equity of $26.65. This is in US dollars, even though the financial statements are in euros, because they do list in the New York Stock Exchange. Now, we have that value of $26.65, but as I said, they had a whole lot of debt. So I have to subtract the debt from that total value. So subtracting the debt from the total value, we actually get a fair value of $14.65. Okay? So let's look at where the stock of Nomad Foods is right now. Wow. So a few observations here. First of all, if you've invested in Nomad Foods 5 years ago, you're not happy with your investment. You would have probably been very happy here. If you exited somewhere in early 2021, early to mid 2021, you would have been fine. Nowadays, you're probably not very happy. That's interesting, right? And I think it's also correlated a little bit with the stagnating European economy and the fact that inflation there has been felt a lot worse than, for example, in the United States or in other parts of the world. So, PE ratio 13.81, dividend yield 3.4-ish%. That's really healthy, actually. That's really nice. And there's been just a recent down. I think one of these coincided with the fact that one of their acquisitions got blocked. But regardless, you are not very happy as a shareholder. Although note that the 17.69 valuation is somewhere in the middle between this number that I got pre-debt, 26.65, and this number that I got post-debt of 14.65, right? So what do we do here in this case? Well, when you are doing a calculation and you get this number that is in between the pre and the post debt, that's where you start looking at the makeup of the debt and you start looking at the trajectory of the debt, which is why I included this, where I'm telling you they issued 800 million and then another 800 million worth of debt. They paid off 1.3 billion. So they are still issuing more debt than they're repaying. They have this much of interest. So for example, we're seeing the free cash flow numbers here, right? Where we're going to say for 2023, they're going to have $328 million and 50, let's say 60, because we're converting it to euros. So 60 million of that is just going to go to pay debt. So all of a sudden they're less flexible. They have less money available with which to pay their dividends, with which to repurchase shares, or which to invest back in the business. So it's just very important to note what the debt mix is there and if it really matters to you. And something to note too is that they're going to be especially sensitive to interest rates, of course. If interest rates go up, their debt goes up, those interest payments go up. If interest rates go down, they may be able to refinance it at better terms. So that's very important, and that's something that we'll talk about in a little bit. I also want to just put out a valuation that is not based on discounted cash flow, but on EV to EBITDA. We'll see that their trailing EV to EBITDA is 9.5 times, their forward is 10.4 times, the industry median is 12.1 and 11.2 times respectively, which is a little lower here, but it doesn't seem to be exorbitantly low or exorbitantly high. So it's about in line, which, well, if we consider this model to basically fairly value this company that is somewhere in between, then EV to EBITDA is basically confirming that at least relative to the industry, it's fairly valued. Okay? Now, in summary, the valuation seems, in my opinion, fair for Nomad Foods. This company is a solid performer despite the high debt. It's growing revenues, it's doing it very consistently. It has very healthy gross margins and even net profit margins. Its gross margins are around 30%, which is very impressive actually, and its net profit margins are around 10 to 15%. Not bad. The top line revenue growth is wonderful, as I said. However, concerns remain regarding inflation and growth in the Eurozone and their ability to pass that on to the consumer. Of course, there are going to be hard times if there's a recession in the Eurozone. And the pro of that, however, is that they may be able to refinance their interests or their debts at a lower interest rate. And that may be a boon, an unexpected boon, that even though they have lower revenues, they may be able to just pay down that debt for way cheaper. So it's going to be important to watch the margins and the interest rates. And debt repayments and nice dividends should also increase shareholder value paired with the stock buybacks. And at the end of the day, even though the margins are decreasing, net income, gross income, operating income, all of that is increasing along with the revenue. So I wouldn't say it's a critical issue that this company has, but it's something that if you are interested in buying Nomad Foods and adding this to your portfolio, you have to be looking at the debt composition, at the direction that the debt is going, and seeing if those margins are going to recover. Okay? So, what I'm basically saying here is to watch the margins and watch the debt. In these companies, if you're a long-term investor, that's going to be very important. Now, I hope you got a lot out of this video. This was a very fun company to just look at and dissect a little bit. I hope you learned a lot. If you have any companies that you want me to take a look at, comment down below. I'd be happy to take a look at them. And with that said, don't forget to like and subscribe if you like this video, and have a great rest of your day.